Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Furthermore, past performance, whether in a live trading environment or a simulated demo environment, is not indicative of future results. Demo accounts described in this presentation often simulate market conditions that may not perfectly reflect the liquidity, slippage, and execution speeds found in live markets during periods of high volatility. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. There is a statistic that circulates in the backrooms of Wall Street and the private servers of proprietary trading firms, a number so brutal that most brokerage marketing departments will do everything in their power to hide it from you. It is widely referred to within the industry as the 90-90-90 rule. It states that 90% of retail traders will lose 90% of their account capital within their first 90 days of active trading. Let that sink in for a moment. If you walked into a university, a medical school, or a pilot training program where the failure rate was 90% in the first 3 months, you would likely turn around and run the other way. Yet, every single day, thousands of aspiring traders in the United States deposit their hard-earned savings, mortgage payments, retirement funds, emergency cash, into live brokerage accounts without a single hour of valid, structured practice. They are essentially stepping into a cage with heavyweight champions while having never thrown a punch in a gym. They are bringing a plastic knife to a thermonuclear war. The financial markets are not a game. They are a zero-sum arena where for you to profit, someone else, often a bank with billion-dollar algorithms or a hedge fund with armies of PhD mathematicians, must potentially take a loss, or you must align perfectly with the momentum they create. The reason for this catastrophic failure rate is rarely a lack of intelligence or a lack of capital. It is almost exclusively a lack of preparation in a risk-free environment that accurately mimics the psychological and technical stresses of the real world. Most new traders treat the market like a casino rather than a profession. They view a demo account as a boring formality, a hurdle to jump over so they can get to the real action. This mindset is exactly what the institutional smart money is counting on. They rely on the impatience of the retail sector to provide liquidity for their own massive positions. When you enter the market unprepared, you are not an investor. You are liquidity. You are the fuel for someone else's fire. But there is a way to invert this dynamic. There is a way to survive the initial 90 days without losing a single cent of your actual net worth. There is a method to pay your market tuition using virtual currency while gaining legitimate, hard-won experience that translates to the live charts. This deep dive masterclass is designed to solve that specific problem for you today. We are going to dismantle the amateur approach to Forex trading and replace it with a professional infrastructure. The promise of this series is not to give you a magic button that prints money. That does not exist, and anyone telling you otherwise is selling you a lie. The promise of this series is to equip you with the flight simulators of the trading world. Just as a commercial airline pilot must log hundreds of hours in a simulator, dealing with engine failures, crosswinds, and emergency landings, before they are ever allowed to touch the controls of a passenger jet, you must log your hours in a demo environment that respects the reality of the market. However, not all flight simulators are created equal. Some demo accounts are rigged toys designed to give you a false sense of confidence, filling your orders at prices that don't exist and ignoring the spread costs that will eventually eat your profits in the real world. Using a bad demo account is actually worse than no practice at all, because it trains your brain to expect easy wins in conditions that are purely fictional. It builds bad habits that will be ruthlessly exploited the moment you switch to live capital. In this comprehensive guide, we are going to navigate the specific landscape of the United States Forex market. This is critical because the U.S. regulatory environment is unlike any other in the world. Under the jurisdiction of the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, U.S.-based traders face strict constraints that global traders do not. You have to deal with the FIFO rule, first in, first out, which dictates the order in which you can close multiple trades on the same currency pair. You are restricted from hedging, meaning you cannot hold a buy and a sell position on the same pair simultaneously in the same account. You are capped at 50:1 leverage on major pairs, whereas offshore brokers might offer dangerous 500:1 leverage. If you practice on a generic international demo account that allows hedging and offers 500:1 leverage, you are training for a sport you will not be allowed to play. You are practicing rugby when the game you will be playing is American football. The rules are fundamentally different. Therefore, the demo accounts we identify and analyze in this series are selected specifically for their adherence to U.S. regulatory standards, their technical reliability, and their ability to bridge the gap between simulation and reality. We are looking for platforms that offer realistic spreads, not artificially tightened ones that vanish when news breaks. We are looking for execution speeds that mimic the latency of a real server, so you understand how slippage works before it costs you money. We are looking for charting software that matches the industry standards used by professionals, ensuring that your technical analysis is based on clean, high-quality data feeds. This is not just about downloading an app and pressing buy or sell. This is about constructing a rigorous testing environment where you can validate your trading edge. A trading edge is a statistical advantage that, over a large enough sample size of trades, produces a net profit. You cannot determine if you have an edge if your testing data is flawed. If your demo account fills your take-profit order when the price merely touched the level, but a live account would require the price to trade through the level to cover the spread, your data is corrupted. You might think you have a winning strategy when, in fact, you have a losing strategy that only works in the fantasy land of a low-quality simulation. We will explore the critical differences between market maker demos and ECN, electronic communication network, style demos, and why understanding the back-end technology of your broker is just as important as understanding the chart in front of you. Furthermore, we will discuss the psychological component of demo trading. The biggest criticism of demo accounts is that they lack the emotional weight of real money. When you lose 1,000 virtual dollars, your heart rate doesn't spike. You don't sweat. You don't feel the urge to revenge trade to get it back. This is true, but it is also a hurdle that can be managed with the right approach. We will discuss how to treat a demo account with the same seriousness as a live account, including how to set realistic deposit amounts. Many traders open a demo account with $100,000 of virtual cash when they only plan to deposit $1,000 of real money. This is a fatal error. It distorts your perception of risk and reward, making a $500 profit on a $100,000 account feel small, but on a $1,000 account it is a 50% gain, a massive, often unsustainable swing. We will guide you on how to calibrate your demo settings to mirror your actual financial reality, creating a seamless transition when you are finally ready to go live. This series is your safeguard. It is the firewall between your current inexperience and the potential loss of your capital. By the end of this masterclass, you will know exactly which platforms offer the best charting, the most realistic data, and the most user-friendly interfaces for the US market. You will understand how to use these tools to backtest strategies, forward-test execution, and build a track record that proves mathematically that you are ready to trade. You will stop guessing and start executing. The journey from novice to professional does not begin with a deposit. It begins with a simulation. Let's begin the process of professionalizing your approach to the markets. Imagine for a moment that you are training to become a high-performance race car driver. You spend 6 months practicing on a video game console in your living room. In this game, your tires never lose grip, the rain doesn't affect your braking distance, and if you crash into a wall at 200 miles per hour, the car simply bounces off with a minor scratch. You start breaking track records in the game. You feel invincible. You feel ready. Then the day comes when you step onto a real asphalt track in a real Formula One car. It starts to drizzle. You take the first corner at the same speed you did in your living room. The result? You spin out, crash, and destroy a multi-million-dollar machine in seconds. This is the exact reality facing thousands of aspiring traders right now. They are practicing on video game demo accounts that bear almost no resemblance to the friction and brutality of the live foreign exchange market. To avoid crashing your capital on day one, we must establish a rigorous set of criteria for what constitutes a professional-grade demo environment. We are not looking for a game. We are looking for a stress test. The first and most critical criterion is execution reality. Most standard demo accounts operate on what industry insiders call a zero-latency, infinite liquidity model. In this fictional environment, when you click the buy button at a specific price, Let's say 1.1050 on the euro to US dollar pair. The demo server immediately confirms that you bought $10 million worth of currency at exactly 1.1050. It assumes that there is always someone willing to sell you that amount at that exact price, instantly. In the real world, liquidity is finite. If you try to buy a large position during a quiet market session, or during a chaotic news event like the non-farm payrolls release, there may not be a seller at 1.1050. The nearest seller might be at 1.1055 or 1.1060. This phenomenon is called slippage, and it is the silent killer of retail trading strategies. A professional-grade demo account attempts to simulate this. It will not fill your order if the market liquidity isn't there, or it will fill you at a slightly worse price to mimic the reality of the order book. Consider the case of a hypothetical scalper named Marcus. Marcus developed a strategy on a low-quality demo account that relied on capturing very small movements of just 2 or 3 pips. On his demo, his orders filled instantly, and he showed a 90% win rate. He felt ready to mortgage his house. But when he went live, the split-second delay in real-world order routing, combined with natural market slippage, meant his 3-pip profit targets were being eaten up by entry delays. His strategy wasn't profitable. His simulation was just flawed. To avoid becoming Marcus, you must seek out demo accounts provided by brokers who use ECN, Electronic Communication Network, or STP, straight-through processing technology, even in their simulation servers. You want a demo that occasionally gives you a requote or a bad fill. You want a demo that struggles when the market moves fast. It sounds counterintuitive, but you want a demo account that is difficult to trade on because the live market will be even harder. The second non-negotiable criterion is spread accuracy. The spread is the difference between the buy price and the sell price, essentially the commission you pay to the broker and the market makers on every single trade. In many basic demo accounts, the broker sets a fixed spread. They might lock the spread at 1 pip for the euro to US dollar pair. Regardless of what is happening in the world, this creates a false sense of security. In the live US market, spreads are variable, floating. During the New York session overlap, the spread might be tight, perhaps 0.1 or 0.2 pips. But at 5 p.m. Eastern Standard Time, when the New York market closes and liquidity dries up for the daily rollover, spreads can widen massively to 5, 10, or even 20 pips. If your demo account does not replicate this widening of the spread, you will likely hold trades overnight thinking you are safe, only to wake up and find your stop loss was triggered not by price movement, but by the spread widening. Imagine a scenario where you are holding a short position. The chart shows the price never touched your stop loss, yet you were stopped out. In a fixed spread demo, this never happens. In a live account, it happens every day. You need a demo account that pulls live, raw data feeds from the interbank market, showing you exactly how ugly the pricing can get when market volume disappears. This teaches you not just how to trade, but when not to trade. It forces you to respect the rollover period and factor volatility into your risk management models. The third criterion specifically for US-based traders is regulatory alignment. As we touched upon previously, the US trading environment is restricted. If you download a demo platform from an unregulated offshore broker, they might offer you 500:1 leverage. This means for every $1 you put up, you can control $500 worth of currency. It sounds exhilarating, like driving a car with a rocket booster. You can turn a tiny account into a fortune in minutes in the demo. But in the US, the legal limit for major pairs is 50:1. If you practice your position sizing and risk management based on 500:1 leverage, you are learning a mathematical language that is illegal for you to speak in the real world. When you finally open a regulated US account, you will find your margin requirements are 10 times higher than what you practiced with. You will try to open a trade and get a "not enough money" error message. You will be confused and frustrated because your intuition for how much capital is required for a trade is completely wrong. Furthermore, US regulations enforce the FIFO, first in, first out, rule. If you open 2 buy positions on the same pair, you must close the first one you open before you can close the second one. Most international demos do not enforce this. They let you pick and choose which trade to close. If you build a strategy that relies on closing newer trades while keeping older ones open, that strategy will physically fail to execute on a US broker's live server. Therefore, your demo account must have a US account type, setting that enforces FIFO and 50:1 leverage caps. You cannot train for the NFL by playing rules that allow forward passes from anywhere on the field. You must train within the constraints of the game. The fourth criterion is Historical data integrity. When you look at a chart on a demo account, you are looking at a visual representation of data points. Not all data is clean. Some low-quality demo feeds have bad ticks, spikes in price that never actually happened in the real market, caused by a data glitch. If you are backtesting a strategy, these bad ticks can trigger false signals, making a losing strategy look like a winner or vice versa. High-quality US brokers spend millions on their data infrastructure to ensure their demo feeds match their live feeds as closely as possible. They scrub the data of errors. You need to practice on the same software that the professionals use. In the US context, this usually means MetaTrader 4, MetaTrader 5, or increasingly TradingView integrations. However, simply using the software isn't enough. The data feeding into the software must be the broker's own data, not a generic feed from a third party. You want to see the broker's specific price candles because eventually, you will be trading against those specific prices. Finally, we must address the psychological sandbox. This is a criterion you must impose on the demo account yourself. Most brokers will default your demo opening balance to $100,000 or even $1 million. This is a marketing tactic. They want you to see big numbers. If you make a 1% return on $1 million, you see a profit of $10,000. Your brain releases dopamine. You feel successful. But if your actual plan is to deposit $5,000 of your savings, that $10,000 profit is a complete fantasy. It creates an anchoring bias. You get used to seeing 4- and 5-figure swings in your P&L, profit and loss. When you switch to your real $5,000 account, a 1% gain is only $50. Feels insignificant. Feels like a waste of time. This leads to over-leveraging, where you risk too much trying to chase that $10,000 high you felt in the demo. A professional-grade approach requires you to manually adjust the demo balance to match your intended live deposit exactly. If you are going to invest $3,000, open the demo with $3,000. If the broker doesn't allow a custom amount, open it with the minimum and trade it down or contact support to adjust it. You need to condition your emotional response to the realistic dollar values you will be handling. You need to feel the grind of growing a small account, not the fantasy of managing a hedge fund. Now that we have established the strict criteria for a high-fidelity simulation, realistic execution, variable spreads, US regulatory alignment, clean data, and psychological calibration, the question becomes, who actually offers this? Which specific US brokers meet these rigorous standards, and which ones are falling short? In the crowded marketplace of financial services, distinguishing the high-performance tools from the marketing gimmicks is a daunting task. We have tested the platforms, analyzed the data feeds, and scrutinized the user agreements to find the answers. What we found might surprise you because the most popular name is not necessarily the most accurate one. Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any dough. BTS. Past performance, whether in a live trading environment or a simulated demo environment, is not indicative of future results. Demo accounts described in this presentation often simulate market conditions that may not perfectly reflect the liquidity, slippage, and execution speeds found in live markets during periods of high volatility. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. When we peeled back the layers of marketing gloss and looked strictly at the engine room of US available trading platforms, two giants emerged from the mist. These are not necessarily the platforms with the loudest YouTube ads, but they are the ones with the deepest infrastructure. We are talking about OANDA and IGUS. But do not make the mistake of thinking they are interchangeable. They are fundamentally different tools for different types of craftsmen. Let's dissect them, starting with the data heavyweight OANDA. If you are a trader who obsesses over precision, risk management, and historical accuracy, OANDA's demo account offers a feature that is practically a superpower for small accounts: nanolot, or unit-based trading. In the standard Forex world, you are often forced to trade in lots. A standard lot is 100,000 units of currency. A mini lot is 10,000. A micro lot is 1,000. If you have a $500 account and you want to follow a strict 1% risk rule, meaning you can only lose $5 on a trade, the math often doesn't work with micro lots. The stop loss would have to be too tight, or you simply can't take the trade. You are priced out of proper risk management. OANDA changes the physics of this problem. Their demo and their live account allows you to trade as little as one single unit of currency. Imagine this scenario. You are Sarah, a new trader with a $1,000 demo account. You spot a setup on the daily time frame, but your stop loss needs to be 100 pips away to be safe. On a standard broker, the smallest trade you can take, 0.01 lots, would risk $10. That is 1% of your account. Acceptable. But what if your account was $500? That same trade would risk 2%, breaking your rules. On OANDA, Sarah can type in 500 units instead of 0.01 lots. She can risk exactly $5 or $2.50 or 75 cents. This flexibility in the demo environment allows you to practice position sizing with a granularity that no other major US broker offers. It prevents the rounding error that blows up small accounts. Furthermore, OANDA is technically a data company that happens to offer trading. Their historical price feed is often used as the benchmark by audit firms and tax authorities. When you backtest on their demo, you are using the gold standard of pricing history. However, there is a catch. OANDA spreads can be variable. During the witching hour of the daily rollover 5 p.m. Eastern Standard Time, spreads on pairs like pound sterling to Australian dollar can widen significantly. If your demo strategy relies on tight stop losses held overnight, OANDA's realistic spread widening simulation will stop you out. This is painful, but it is good pain. It teaches you the cost of doing business. Now let's pivot to the other titan, IGUS. If OANDA is the precision scalpel, IG is the aircraft carrier. IG is arguably the largest provider of CFDs and Forex in the world by revenue, and their US entity brings that institutional heft to your desktop. The standout feature of the IG demo is the platform itself. It is clean, web-based, and incredibly fast. Feels less like 1990s software, which is what MetaTrader 4 looks like, and more like a modern fintech dashboard. Consider Mike, a scalper who relies on speed. He needs to see the chart, the ticket window, and his open P&L, profit and loss, in one glance. On IG's web platform, the layout is customizable and fluid, but the real value lies in their execution logic. IG's demo is famous for simulating partial fills. In a live market, if you try to buy 50 lots, a massive position, you might get 10 lots at one price, 20 at a slightly worse price, and the rest at an even worse price. Most demos just give you all 50 lots at the best price. IG's technology attempts to show you the depth of the market. It trains you to understand that size is an enemy of execution. However, IG has a specific quirk regarding US regulations that you must master in the demo. The FIFO rule is visualized differently. On some platforms, FIFO is a hidden rule that just rejects your order if you try to close the wrong one. On IG's platform, they often force you to view positions as an aggregate. If you buy euro to US dollar 3 times at different prices, IG might show you one single average entry price. This simplifies the visual, but it can confuse you if you are trying to target a specific exit for just one of those 3 entries. Practicing on their demo forces you to adapt to this net position view, which is critical for managing complex trades without violating NFA compliance rule 2-43b. There is also the issue of demo rot. Most standard demo accounts, including those on standard MT4 servers, will expire after 30 to 90 days of inactivity. OANDA's MT4 subaccounts can expire if dormant, but their proprietary accounts tend to be more resilient as long as you log in. IG's demos are also subject to inactivity timers. The solution? Treat your demo like a plant. You must water it. Log in once a week, place a microtrade, and keep the data feed alive. If you let it lapse, you lose your trading history, your journal of mistakes and victories, which is the most valuable asset you have. So, we have OANDA for the data purists and the risk management technicians who need unit sizing. We have IG for the execution-focused traders who want a modern, institutional-grade interface. But there is a third player. A player that isn't a broker at all, but a piece of software that has consumed the entire industry. It is the platform that 50 million traders look at every single day, yet most of them don't realize they can use it as a standalone simulation engine. without ever connecting a broker at all. It offers a replay mode that allows you to relive the past 10 years of market data as if it were happening live, candle by candle. This is the hybrid solution. It solves the problem of waiting. In a normal demo, if you want to practice trading the London Open, you have to wake up at 3 a.m. But with this specific tool, you can trade the London Open at 8 p.m. on a Tuesday over and over again, compressing months of learning into a single evening. It is the ultimate accelerator for the novice mind. We are talking, of course, about TradingView. For years, this platform was simply where you went to draw your lines before switching over to a clunky broker terminal to actually push the buttons. It was a disconnect, a friction point where errors occurred. You would analyze on a beautiful modern chart, then fumble with an archaic order ticket on a different screen, miscalculate your lot size, and enter the trade too late. That era is over. TradingView's paper trading panel has integrated the simulation directly into the analysis, but its true weapon, the feature that separates the casual hobbyist from the dedicated student, is the bar replay mode. Think of this as a DVR for the financial markets. It allows you to delete the future. You can load up the pound sterling to Japanese yen chart, scroll back to say Tuesday, March 14, 2023, and slice off everything that happened after 3 a.m. To your eyes and to the software's engine, it is now 3 a.m. on that specific Tuesday. The candles to the right do not exist yet. You can then press play and watch the market unfold at your chosen speed. 1 candle per second, 1 candle per 3 seconds, or manually clicking forward 1 bar at a time. Consider the case of David, a software engineer living in San Francisco. David wants to trade the London breakout strategy, a volatile window of time when the European markets open. The problem is, for David in the Pacific time zone, the London Open happens at midnight. He has a demanding job. He cannot stay awake all night and function the next day. In the old world, David simply couldn't trade this strategy. He would be forced to trade the New York session, which might not suit his personality or his statistical edge. But with the replay function, David comes home from work at 6 p.m. He opens his laptop, selects the pound sterling to US dollar pair, rewinds the chart to the previous night's midnight candle, and begins his session. He analyzes the market structure exactly as if it were live. He places his pending buy stops and sell stops. He advances the candles. He sees his order get triggered. He manages the trade, trailing his stop loss as price moves in his favor, or accepting the loss if it reverses. He does this for the Monday session, then the Tuesday session, then Wednesday. In 2 hours of real time, David has traded a full week of London Opens. In 1 month of focused practice, he can simulate 2 years of market experience. This is the concept of time compression. While the average novice waits 24 hours to get feedback on one trade, David gets feedback on 20 trades in a single evening. His learning curve is not linear, it is exponential. He is spotting patterns 10 times faster than the guy waiting for the live market to move. But the speed is only half the equation. The other half is the interface itself, specifically the long position and short position drawing tools. On a standard MetaTrader demo, if you want to risk exactly 1% of your $10,000 account with a 15 pip stop loss, you have to do math. You have to open a calculator, take your equity, multiply by 0.01, divide by the stop loss distance, and convert that into standard lots. Takes time. In a fast-moving market, by the time you do the math, the trade is gone. In TradingView's paper trading environment, this friction is eliminated. You simply click the long position tool and draw your trade on the chart visually. You drag the stop loss line to below the swing low, and you drag the take profit to your target. The tool automatically tells you, if you take this trade, you will lose X dollars or gain Y dollars. But it goes deeper. You can configure the settings to always risk 1%. Now, no matter how wide or tight you drag that stop-loss line, the software automatically recalculates the position size to ensure you never lose more than that 1% risk. When you click buy, it executes that exact calculated size. This builds a critical muscle memory, thinking in percentages, not dollars. You stop seeing a trade as, I want to make $500. You start seeing it as, I am risking 1R to make 3R. This shift in perspective is the hallmark of professional trading. You are training your brain to focus on the risk-to-reward ratio rather than the raw cash value, which is essential for emotional stability when you eventually switch to live capital. However, we must address the data trap. TradingView is platform neutral, meaning it pulls data from various sources like FXCM, OANDA, or IDC. These data feeds are often consolidated, or indicative. They represent an average of the market prices. They are often too clean. In a live broker account, you will see wicks, those thin lines extending from the candle body, that might be 5 pips lower than what you see on a generic TradingView chart. Why? Because brokers widen their spreads, and price varies slightly from liquidity provider to liquidity provider. Imagine a scenario where you are backtesting a strategy that relies on wick entries, placing a limit order at the very tip of a previous candle's wick. On the TradingView simulation, your order gets filled perfectly, and the price reverses beautifully. You record a win. You feel like a genius. But in the live market, the broker's spread might have been just wide enough that the price technically reached your level, but the ask price never crossed it to fill your buy limit. You would have been left behind, watching the trade go to the moon without you. Or worse, the bid price dipped lower than the generic feed showed, triggering your stop loss before reversing. To mitigate this, you must be intentional about which data feed you select inside the simulation. Do not use the default IDC feed if you plan to trade with OANDA. Select the OANDA feed specifically within the TradingView symbol search. This ensures that the candles you are practicing on are the same candles your broker will serve you. It brings you one step closer to reality. Furthermore, there is a psychological danger in the replay mode that you must actively guard against: the hindsight bias. When you are scrolling back to find a start date, your eyes inevitably catch glimpses of the future price action. You see that big crash in October. Subconsciously, when you start your replay session in September, you are biased towards selling because you know the crash is coming. This corrupts your data. You aren't trading the chart in front of you. You are trading your memory of the future. To fix this, successful practitioners use the go to date function to jump blindly to a random date in the past, often covering the right side of the screen with a physical piece of paper, or using a browser extension that blurs the future until they activate the replay. You have to trick your brain into believing the uncertainty is real. There is also the limitation of fundamental blindness in replay mode. When you are replaying a Tuesday from 3 years ago, you likely don't know that on that specific morning the Federal Reserve Chairman was giving a surprise speech. On the chart, you see a massive, inexplicable spike that stops you out. In real life, you would have seen the news on your calendar and stayed out of the market. In the replay, it just looks like a technical failure. This can lead you to discard a perfectly good technical strategy because it failed during a historical news event that you were unaware of. The workaround is to keep a historical economic calendar open in a separate tab, set to the same date as your replay, so you can cross-reference, why did the market move like that? Despite these nuances, the TradingView paper trading ecosystem remains the most powerful flight simulator for market structure and pattern recognition. It allows you to build a database of thousands of trades in the time it takes a normal person to take 50. It allows you to fail faster. If you are going to lose your first 90 trades, as the statistics suggest, would you rather spread that pain out over 6 months of live trading and thousands of dollars in losses, or get it over with in 2 weekends of intense, risk-free simulation? But here is the catch. Having the best flight simulator and the best airplane doesn't matter if you don't have a flight plan. You can download OANDA, set up IG, and master TradingView replay, but if you are just randomly clicking buttons based on gut feeling, you are not practicing. You are just hallucinating productivity. You are cementing bad habits at record speeds. To turn this simulation into a career, you need to transition from playing to testing. You need a structured scientific method to record, analyze, and optimize your performance. You need to know exactly what metrics to track, because profit is actually a terrible metric for judging a beginner's skill. There is a specific set of 5 key performance indicators, KPIs, that hedge funds use to evaluate their junior traders. They don't look at the total dollar amount made. They look at the stability of the curve. They look at the drawdown duration. They look at the expectancy ratio. Most retail traders have never even calculated these numbers. Most retail traders look at their demo account history, see a green number at the bottom that says plus $500, and assume they are ready for the big leagues. This is a delusion. That $500 tells you absolutely nothing about the sustainability of your method. You could have made that $500 by risking $5,000 on a single coin flip that happened to go your way. That is not trading, that is accidental survival. To structure your demo testing like a professional fund manager, you must ignore the raw dollar amount and focus exclusively on the vital signs of your strategy. These are the 5 key performance indicators that determine if you have a viable business or just a gambling addiction. The first KPI is the profit factor. This is the raw efficiency rating of your engine. It is calculated by dividing your gross profit by your gross loss. Note that we are not looking at net profit here. If you made $10,000 in winning trades but lost $9,000 in losing trades, your net profit is $1,000. You might feel good about that, but your profit factor is 1.11. That is terrifyingly low. It means for every dollar you lose, you are barely making $1.10 back. You are running on razor-thin margins. One bad week, one fat finger error, or one market crash could wipe you out. Contrast this with a trader who made $2,000 in gross profit but only lost $1,000 in gross loss. Their net profit is also $1,000, same as the first guy, but their profit factor is 2.0. This trader is twice as efficient. Their strategy is robust. They can absorb a string of losses and still be profitable. In your demo testing, you are aiming for a profit factor above 1.5. Anything below 1.2 is statistical noise that will likely turn into a loss when you add real money emotions and slippage. The second KPI is the dynamic relationship between win rate and risk-to-reward ratio. This is where the marketing lies usually live. You will see YouTube thumbnails screaming, 90% win rate strategy. Do not fall for it. A 90% win rate is often a trap. Imagine a strategy that wins 9 out of 10 times. Sounds perfect. But on those 9 wins, you take a tiny profit of $10. That's $90 in the bank. On the one loss, however, you hold on to the trade too long, refusing to be wrong, and you lose $100. You have a 90% win rate, but you have lost $10 overall. You are bleeding to death while feeling like a winner. Professional trading is often the opposite. Consider the trend follower. They might have a win rate of only 40%. They lose 6 times out of 10. To the amateur, this feels like failure. But when they lose, they cut it fast, losing $1. When they win, they ride the trend and make $3. Let's run the math on 10 trades. 6 losses at $1 equals minus $6. 4 wins at $3 equals plus $12. The result? A net profit of $6. They lose more often than they win, yet they are profitable. In your demo, you must stop trying to be right and start trying to be profitable. Track your average winner versus your average loser. If your average loser is bigger than your average winner, you are walking a tightrope without a net. The third KPI is maximum drawdown. This is the metric that gets you fired from a proprietary trading firm. It measures the percentage decline from your account's highest peak to its lowest trough. If you grow your demo account from $10,000 to $15,000, and then you lose your way back down to $12,000, your drawdown is not calculated from the starting balance. It is calculated from the $15,000 peak. That is a $3,000 loss, or a 20% drawdown. Why does this matter? Because of the recovery math. If you lose 10% of your account, you need an 11% gain to get back to break-even. That is manageable. But if you lose 50% of your account, say dropping from $10,000 to $5,000, you now need to make a 100% return on that $5,000 just to get back to where you started. You have dug a hole so deep that you have to perform like a superstar just to be average. In your demo phase, any strategy that produces a drawdown greater than 20% is a failed strategy. It doesn't matter if it eventually made money. The risk of ruin was too high. You must scrap it or re-engineer your risk management. The fourth KPI is expectancy. This is the single most important number in trading. It answers the question. On average, every time I push the button, how much money do I make or lose? It combines your win rate and your risk reward into a single value. The formula is win percentage x average win size minus loss percentage x average loss size. Let's say you have a strategy with a 50% win rate. You win $200 on average and lose $100 on average. Open parenthesis 0.50 times 200 close parenthesis minus open parenthesis 0.50 times 100 close parenthesis is equal to 150 equals $50. This means your expectancy is positive $50. Over the long run, every single trade is worth $50 to you, even the losing ones. This is how casinos view the roulette wheel. They know they will lose some spins, but they know their mathematical expectancy is positive. They don't sweat the individual losses because the math guarantees their profit over time. If your demo calculation shows a negative expectancy, stop trading immediately. You are the gambler, not the house. The fifth and final KPI is drawdown duration. This is the psychological killer. It measures time. How long does your account stay underwater? Imagine Trader A and Trader B. both have a 20% drawdown. Trader A recovers their losses in 2 weeks. Trader B grinds sideways, taking small wins and small losses, and doesn't get back to their high water mark for 6 months. Trader B is in a stagnation period. In a demo, this feels boring. In real life, this leads to emotional collapse. When you are working hard for 6 months and seeing zero net progress, you will inevitably try to force a trade. You will up your size to make it back fast. That is the moment you blow the account. You must analyze your demo data to see how long your recovery periods are. If your strategy goes into hibernation for months at a time, it is not suitable for a daily income approach. You need a method that turns over capital efficiently. Now, how do you actually execute this test? You cannot just trade randomly and look at the stats at the end of the month. You must use block testing. This is the scientific method applied to markets. You commit to taking a block of 20 trades, no more no less, following your rules exactly. You do not change the rules after trade 3 because you took a loss. You do not tweak the stop loss after trade 7 because you got scared. You execute the full block of 20. Only after the 20th trade do you stop and calculate your 5 KPIs. If the data is bad, you tweak the strategy and start a new block of 20. This isolates the variables. If you change your rules in the middle of a block, your data is contaminated. You won't know if the result was due to the original strategy or the mid-game changes. Most traders never finish a block. They get discouraged after 3 losses, change indicators, switch timeframes, and restart the cycle of doom. They are constantly testing the first 3 trades of a new strategy and never seeing the long-term probability play out. So, you have your demo account set up on a professional US platform. You have calibrated the balance to be realistic. You are committed to block testing and tracking these 5 KPIs. But there is a glaring problem. The broker's built-in history tab is garbage for this type of analysis. It gives you a list of numbers, not insights. It doesn't calculate expectancy or drawdown duration for you. If you try to do this manually in a spreadsheet, you will get lazy, you will make data entry errors, and you will eventually stop doing it. You need an automated external brain. You need a digital auditor that plugs into your demo account and rips the data out to analyze it for you. There are specific tools, some free, some paid, that act as the scoreboard for your professional journey. Without them, you are flying blind. Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance, whether in a live trading environment or a simulated demo environment, is not indicative of future results. Demo accounts described in this presentation often simulate market conditions that may not perfectly reflect the liquidity, slippage, and execution speeds found in live markets during periods of high volatility. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. If you are only using the History tab in your MetaTrader or TradingView terminal to judge your success, you are effectively running a business without an accounting department. The broker's default history shows you what happened: you bought here, sold there, and made $50. But it does not tell you why it happened, or more importantly, how to repeat it. It gives you a ledger, not a lesson. To professionalize your demo phase, you must connect your account to a third-party digital auditor. This is a piece of software that acts as an unbiased observer, verifying your track record and dissecting your behavior with a precision that the human brain simply cannot achieve on its own. There are 2 categories of these tools: the verifiers and the coaches. Let's start with the verifiers. These are the industry standards for proving that your demo results are legitimate. The most famous name in this space is MIFSpook. It is entirely free, and it is the resume of the retail Forex world. If you ever MT to manage money for an investor, or even just prove to your spouse that you aren't gambling away the family savings, a screenshot of your trading terminal is worthless. Screenshots can be photoshopped. A MIFSpook link, however, is verified directly through the broker's server. Setting this up for your demo account is the first step in treating this like a job. You don't need to give MTFSpook your trading password. Instead, you use what is called an investor password, or read-only access. In MetaTrader 4 or 5, you go to Options Server, and you can generate a secondary password that allows someone to look at the trades but not place them. You plug this investor password into MTFSpook, and within minutes, it pulls your entire trading history into a public-facing dashboard. Suddenly, you aren't looking at a list of numbers. You are looking at an equity curve. You can see the visual representation of your consistency. Is your curve a smooth 45-degree angle upwards? Or is it a jagged mess of massive wins and massive losses that just happens to be positive right now? MTFSpook will instantly calculate your Sharpe ratio, a metric that tells you how much risk you are taking to achieve your return. If your Sharpe ratio is below 1, your strategy is likely dangerous, even if it is currently profitable. It will also show you your hour-of-day analysis. You might discover that you are highly profitable between 8 a.m. and 10 a.m., but you consistently lose money during the Asian session. The Broker's History tab will never tell you that. The verifier tells you to stop trading at night. It saves you money by simply highlighting your blind spots. The second verifier option is FX Blue. While MTFSpook is the social resume, FX Blue is the data geek's playground. It offers a tool called the Publisher app. You install a small file into your MT4 folder, and it automatically syncs your trades to their web interface. FX Blue excels at what-if scenarios. It has a filter that lets you ask, what would my results look like if I never took a trade on Friday? You click a button, and it recalculates your entire history excluding Fridays. If your profit doubles, you have just learned a valuable rule. My strategy doesn't work on Fridays. You didn't need to lose more money to learn that. You just needed to audit the data you already had. But while verifiers are excellent for statistics, they lack the nuance of human psychology. This brings us to the second category, the coaches. These are the modern paid journaling platforms like TradeZella or TradesViz. These tools are designed not just to track the numbers but to track the trader. Imagine this scenario. You take a loss. In MTFSpook, it shows up as -$50. In TradeZella, you can tag that trade with a specific psychological label. Was this a FOMO, fear of missing out trade? Did you revenge trade after a loss? Did you follow your plan but the market just moved against you? Over the course of a month, you might tag 20 trades as impulse entry. TradeZella will then generate a report specifically for that tag. It might say, you have lost $4,000 this month. $3,500 of that came from trades tagged impulse entry. This is a revelation. It tells you that your technical strategy is actually fine. You are just losing money because you lack discipline. The software quantifies the cost of your bad habits. It puts a dollar figure on your lack of patience. Seeing impulse trades cost me $3,500 is a visceral, painful wake-up call that a simple spreadsheet cannot provide. Furthermore, these platforms offer playbooks. You can upload screenshots of your chart analysis directly into the journal entry. You can categorize them by setup type, e.g., trend continuation versus reversal. After 100 trades, the software might tell you that you have an 80% win rate on trend continuation setups, but only a 30% win rate on reversals. The actionable advice is clear. Stop trading reversals. You are paying a monthly subscription for a digital mentor that ruthlessly points out your strengths and weaknesses based on your own data. So, here is your workflow for the ultimate demo experience. You open your US-regulated demo account, OANDA or IG. You link it to MTFSpook immediately to establish a verified public record of your journey. This adds a layer of social accountability. You don't want to blow up an account that is being tracked. Then, at the end of every trading day, you sync your data to a journaling platform like TradeZella or a detailed Excel sheet if you are on a budget. You spend 15 minutes tagging your trades with the emotional context of the moment. You upload your before and after screenshots. You do this for 90 days. You do not deposit a penny of real capital until you have a sample size of at least 100 trades. Why 100? Because in a sample of 10, luck dominates. In a sample of 100, probability dominates. If you are profitable after 100 trades with a profit factor above 1.5 and a drawdown below 20%, you have mathematical proof that you are ready. You are no longer guessing. But there is one final piece of the puzzle. We have the broker, the software, and the auditor. We have the infrastructure. But we still need the fuel. We need to talk about the specific drills you should be running in this simulator. Just as a pilot doesn't just fly around in a simulator, they practice stalls, landings, and engine failures. You need specific trading drills to sharpen your execution skills before you ever worry about making a profit. You need to train your eyes to see the market not as a chaotic stream of candles, but as a structured language. Think about a concert pianist. Before they ever step onto a stage to perform a Rachmaninoff concerto, they spend thousands of hours doing something incredibly boring and repetitive, playing scales up and down the keys over and over again until their fingers move without conscious thought. They are building neural pathways. In trading, we don't have scales. We have price action. And just like the pianist, if you try to perform, make money, before you have mastered the scales execution, you will fumble when the pressure is on. Most traders use their demo accounts to simulate a full trading day. They sit there for 4 hours, take one trade, and call it practice. That is inefficient. To compress your learning curve, you need to isolate specific mechanics and repeat them until they are automatic. We call these micro drills. You are not trying to make a profit in these sessions, you are trying to build dexterity. The first drill is the order ticket sprint. This is designed to cure fat finger syndrome, the panic that sets in when price is moving fast and you fumble with the buttons. Open your OANDA or IG demo. Set your time frame to the 1-minute chart on a volatile pair like pound sterling to Japanese yen during the New York session. Your goal here is purely mechanical speed and accuracy. Imagine a scenario where the market spikes. Your task is to enter a buy stop order 5 pips above the current price within 3 seconds. Do it now. Cancel it. Now enter a sell limit order 5 pips above the current price. Do it. Cancel it. Now execute a market buy and immediately place a stop loss exactly 10 pips away and a take profit 20 pips away. Close the trade. Repeat this 50 times. It sounds tedious, but consider the case of Michael. Michael was a brilliant analyst who could predict market direction with 70% accuracy. But during the non-farm payrolls release, he tried to short the market. His hands were shaking. Instead of clicking sell, he accidentally clicked buy because he was looking at the wrong side of the order ticket. By the time he realized his mistake and closed the trade, he had lost 4% of his account in 10 seconds. If Michael had spent 1 hour doing the order ticket sprint, his muscle memory would have saved him. You must know your platform so intimately that you can execute complex orders while blindfolded. You are training your nervous system to remain calm while your fingers do the work. The second drill is the invalidation hunter. This drill focuses exclusively on stop placement. Most amateurs place their stop loss based on their wallet. They think, I only want to lose $50, so they place the stop 10 pips away because that equals $50. The market does not care about your $50. The market cares about structure. A stop loss should only be placed at the point where your trade idea is proven wrong, the invalidation point. For this drill, open your TradingView replay mode. Scroll back to a random date. You are not allowed to take a trade. You are only allowed to place virtual stops. Look at the chart structure. Identify a swing low. Ask yourself, if price breaks this low, is the uptrend over? If the answer is yes, that is your technical invalidation point. Now place your cursor there. But here is the nuance. You must add the buffer. Market makers know exactly where that swing low is. They will often push price 2 or 3 pips below it to clear out the stop orders before reversing. So your drill is to calculate the ATR, average true range of the pair. Let's say the ATR on the 15-minute chart is 8 pips. You will practice placing your stop at the swing low minus 20% of the ATR. If the low is at 1.0500 and the buffer is 2 pips, your stop goes at 1.0498. Hit the next candle button. Watch what happens. Does the price wick down, tag the 1.0500 level, miss your 1.0498 stop, and then fly upwards? If so, you just saved a trade that would have been a loss. Does it smash through both? Then the trend was truly over. Run this simulation for 50 setups. Keep a scorecard. Stops placed based on structure versus stops placed based on fear. You will likely find that giving your trade that extra breathing room, based on volatility, ATR, drastically increases your survival rate. You are learning to pay the insurance premium of a slightly wider stop to avoid the death by noise that kills most retail traders. The third and most advanced drill is the active management protocol. This is where you learn to defend your capital and harvest your profits. Entering a trade is the easy part. Managing it is where the psychological war is fought. The biggest question new traders face is, when do I move my stop to break even? Do it too early, and the market retraces, kicks you out for $0 profit, and then goes to your target without you. Do it too late, and a winning trade turns into a losing trade. In this drill, you will practice the rule of thirds. You will enter a trade in your demo with a position size divisible by 3, for example 0.30 lots. Your target is a 3-to-1 risk-to-reward ratio. As the trade moves in your favor, you must execute a scaling out strategy. When the price travels 1r, the distance of your initial risk, you close 0.10 lots. You bank that profit. You leave the stop loss at the original position. This is controversial. Most people move to break even here. But by banking 1/3 of the profit, you have already financed the risk. If the trade reverses and hits your full stop on the remaining 0.20 lots, you lose less. When the price travels to 2r, you close the second 0.10 lots. Now you move the stop loss to break even. You have locked in profit. You literally cannot lose. For the final 0.10 lots, you do not have a take profit. You use a trailing stop. You trail the stop behind every new market structure low. You let the market take you out. Imagine Jennifer. Jennifer used to close her entire position as soon as she saw green because she was afraid it would disappear. She consistently made $200 profits. But occasionally, she would watch a trade run for $2,000 after she exited. She felt sick. By practicing the rule of thirds in her demo, she learned she could satisfy her urge to bank cash by closing the first third, while still satisfying her ambition to catch the big move by trailing the last third. This drill rewires your dopamine response. It rewards you for patience. Run this management drill on historical data. Replay a trend. Practice the mechanics of partial closing. In MetaTrader, this is a physical skill. You have to double-click the order, change the volume from 0.30 to 0.10, and click Close Market. Takes time. If you fumble this in a live market, you might close the whole thing by mistake. You need to do it 50 times in the demo until your fingers know the dance. These 3 drills, speed execution, structural invalidation, and the rule of thirds, transform the demo account from a passive simulator into an active gymnasium. You are sweating. You are working. You are not just watching candles paint. You are interacting with them. But even with these drills, there is a lingering danger. You can master the mechanics, you can perfect the math, and you can build the muscle memory. But you cannot simulate the chemical reaction that occurs in your brain when real money is on the line. There is a physiological gap between virtual risk and real risk. The demo account, no matter how realistic, cannot replicate the cortisol spike of a drawdown or the euphoria of a winning streak. This is where the bridge comes in. You cannot just jump from a demo account to a full-size live account. That is like jumping from a bicycle to a Ducati. You will crash. You need an intermediate step. You need a way to introduce micro-consequences without exposing yourself to macro ruin. There is a specific type of live account structure, often hidden by brokers, that serves as this missing link. It is the only safe way to graduate from the simulator. Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any dough. BTS. Past performance, whether in a live trading environment or a simulated demo environment, is not indicative of future results. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. The transition from a demo account to a live account is statistically the most dangerous moment in a trader's career. It is the valley of death, where 90% of those who look like geniuses on a simulator suddenly fall apart. The reason is biological. When you trade with virtual money, your amygdala, the part of the brain that processes fear and threat, remains dormant. You are operating from the prefrontal cortex, the center of logic and planning. But the second you risk a dollar that you labored to earn, the amygdala wakes up. It hijacks your decision-making process. Your heart rate elevates. You sweat. You hesitate on entries. You panic exit on pullbacks. You are physically a different person. To cross this valley without dying, you need a bridge that stimulates the amygdala just enough to train it, but not enough to overwhelm it. That bridge is the cent account. Most US traders have never heard of a cent account because major US brokers like OANDA and IG do not explicitly market them under that name due to regulatory structures. But the concept can be engineered using the specific flexibility we discussed earlier. In the international market, a cent account literally displays your balance in cents. If you deposit $10, it shows up as 1,000 cents. You trade cent lots. If you lose 100 cents, you have only lost $1. The psychology is fascinating. You see the number 100 vanish, and your brain feels a pang of loss, but your bank account remains intact. It tricks the brain into taking the game seriously while capping the financial ruin. Since true cent accounts are rare onshore in the US, we use the nanolot bridge strategy on platforms like OANDA to simulate this effect perfectly. Remember, OANDA allows you to trade 1 unit of currency. This is smaller than a micro lot. It effectively allows you to build your own cent account. Here is the step-by-step graduation protocol. You deposit a nominal amount of real capital. Let's say $100. This is money you can afford to light on fire. It is not investment capital, it is tuition. Your goal with this $100 is not to turn it into $1,000. Your goal is to not lose it. You are going to trade with nano-sizing. Imagine Tom. Tom spent 3 months on a demo account. He was up 15%. He felt like a king. He opened a standard live account with $5,000 and started trading mini lots. 0.10. On his first trade, the market moved against him rapidly. He was down $150 in 5 minutes. His stomach churned. He had never felt a $150 loss before. In the demo, it was just pixels. He froze. He didn't cut the loss. He hoped it would come back. It didn't. He lost $500. He revenge traded and lost another $500. In one day, he lost 20% of his savings. Now imagine Jerry. Jerry also spent 3 months on a demo, but instead of jumping to a $5,000 account, he opened a bridge account with $100. He traded 100 units of currency, a nanolot. When the market moved against him, he was down 15 cents. His brain registered the red number. He felt a tiny pinch of annoyance. I hate losing. But no panic. He executed his stop loss calmly. He lost 50 cents. He analyzed the mistake. He placed the next trade. Jerry is exposing himself to micro consequences. He is inoculating himself against the virus of fear. Over the next month, Jerry takes 50 trades. He makes some, he loses some. His account fluctuates between $95 and $105. He is learning to deal with spread widening during news events with real money. He is learning how slippage feels when it actually steals 2 cents from him. He is building emotional calluses. This protocol requires you to stay in the bridge phase for at least 60 days. You are not allowed to add more capital until you have achieved a profitability milestone. For example, you must grow that $100 to $110. That is a 10% gain. It sounds pathetic in dollar terms. It's only $10, barely enough for lunch, but in percentage terms, it is professional grade performance. If you cannot turn $100 into $110, you certainly cannot turn $10,000 into $11,000. The market does not care about the zeros, it cares about the process. During this phase, you must continue to use your digital auditor, TradeZella or MIFSpook. You will notice something strange. Your stats will likely be worse in the bridge account than they were in the demo account. Your win rate will drop. Your drawdown will increase. This is normal. This is the psychological tax. You are measuring the degradation of your skill under pressure. If your demo win rate was 60% and your bridge win rate is 45%, you have quantified exactly how much fear is costing you. Your job is to close that gap before you scale up. Once you have stabilized your bridge account, you begin the scaling ladder. You do not dump your life savings in all at once. You use a doubling strategy. If you successfully grow your $100 to $110 over 60 days with stable metrics, you deposit another $100. Now you are trading with $200. You increase your position size slightly, from 100 units to 200 units. You are acclimating to the new weight. You repeat this process. Grow the $200 to $220. Deposit another $200. Now you are at $400. You are slowly boiling the frog. You are tricking your amygdala into accepting higher and higher levels of risk without triggering the fight or flight response. By the time you reach a $5,000 account, you have earned the right to be there. You haven't just deposited money, you have deposited experience. This approach also solves the slippage reality problem we touched on earlier. In a demo, you never get partial fills. In the bridge account, even with small size, you are interacting with the live server. You will see that during the FOMC meeting, your spread on euro to US dollar might jump to 2 pips. You will see that your limit orders don't always get triggered. You will learn to fear the rollover time. These are lessons that cost Tom thousands of dollars. They cost Jerry a few dollars and cents. Jerry bought his education at a 99% discount. However, there is a trap within the trap. Some traders get stuck in the bridge phase forever. They become comfortable risking $1. They lose the fear, but they also lose the ambition. They treat the market like a cheap video game because the stakes are too low to matter. They start taking sloppy trades because it's only $1. This is risk desensitization. To combat this, you must have a pain threshold. The risk must be small enough to be manageable, but large enough to matter. If losing a trade feels like absolutely nothing, you are trading too small. You need to feel a slight sting. That sting is what keeps you disciplined. It is the electric fence that keeps the cattle in the pasture. As your net worth grows, your pain threshold shifts. For a college student, losing $5 might ruin their night. For a millionaire, losing $5 is invisible. You must calibrate your bridge account size to your personal financial reality. So we have the demo for mechanics. We have the bridge for psychology. We have the auditor for accountability. But what happens when the bridge collapses? What happens when you do everything right, you follow the plan, you manage the risk, and the broker itself betrays you? What happens when the platform freezes during a market crash? Or they widen the spreads to ungodly levels to hunt your stop? You need to know how to stress test your broker before you trust them with your scaling capital. There are specific, aggressive actions you can take in your bridge account to see if your broker is honest or if they are playing against you. You need to try to break them before they break you. Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. You cannot test the integrity of a boat while it is sitting in the harbor on a sunny day. You can only test it in a storm. Similarly, you cannot judge the quality of a Forex broker while the market is drifting sideways during the Asian session. During those calm hours, every broker looks like a saint. Their spreads are tight, their execution is instant, and their servers are responsive. But trading is not about how the platform performs when things are easy. It is about how it performs when the world is on fire. You need to know if your broker is going to be your lifeline or your anchor when the market crashes. This is why the bridge account phase is not just for testing yourself. It is for conducting a forensic audit of the institution holding your money. The vast majority of retail traders operate under the naive assumption that the broker is a neutral utility provider, like the electric company. You flip the switch, the light turns on, and you pay a fee. In reality, the broker-client relationship is complex, and depending on their business model, can be adversarial. In the United States, regulations are strict, which largely eliminates the outright fraud seen in offshore jurisdictions, like disappearing with your money, but it does not eliminate technical incompetence or aggressive risk management on the broker's side. To validate your partner, you must run 4 specific stress tests using your small live account. The first is the news event latency test. This is the most violent test you can run. We are looking for off-quotes errors and platform freezes. Identify a Tier 1 news release on the economic calendar, such as the US CPI, Consumer Price Index, or the non-farm payrolls. These events inject massive volatility into the market in milliseconds. On your demo account, if you try to place a trade during this second, it usually fills instantly at the price you clicked. This is a lie. In your bridge account with your small risk capital, execute a market order exactly 3 seconds after the news breaks. Do not try to predict the news. Just enter the volatility. Watch what happens. Does the order execute immediately? Or does the platform spin for 5 seconds, 10 seconds, or 30 seconds? Does it give you a requote message asking if you accept a price that is 20 pips worse? Does the platform simply disconnect and say common error? If you experience a freeze of more than a few seconds, or if you are consistently unable to execute during volatility, this broker has failed the test. Giant Alex. Alex built a strategy based on news momentum. It worked flawlessly in the simulation. He funded a $20,000 account. During the next Federal Reserve announcement he tried to enter. The platform froze. He couldn't enter. Worse, he couldn't exit a losing position he was already in. By the time the server responded, the market had moved 50 pips against him. He lost $1,000 because of server latency. Not bad analysis. If Alex had run this test with a $100 account first, he would have known to switch brokers before risking his savings. The second test is the Phantom Wick audit. This is designed to detect stop hunting or poor data aggregation. Stop hunting is a controversial term, but in technical terms, it refers to when a broker's specific liquidity providers widen the spread so aggressively that the bid price hits your stop loss, even though the general market price never actually reached that level. To run this test, you need a control group. Open your broker's chart on one screen. On a second screen, open a neutral, high-quality data feed on TradingView, for example the IDC feed or a composite index. You are looking for discrepancies. Let's say you are long euro to US dollar with a stop loss at 1.0500. During a quiet period or a minor move, watch closely if your broker's price dips to 1.0498, triggering your stop, while the neutral feed never went below 1.0505. If you see a candle on your broker's chart that has a long wick pointing down that does not exist on the neutral chart, that is a phantom wick. It represents a momentary collapse in liquidity specific to your broker. If this happens once, it might be a glitch. If it happens consistently near major structural lows where retail stops are clustered, you are trading in a hostile environment. You are playing poker against a dealer who can peek at your cards. In the US regulated market, this is less about malicious intent and more about the broker having thin liquidity providers, but the result for your wallet is the same. You lose money you shouldn't have lost. The third test is the rollover spread expansion. At 5 p.m. New York time, the Forex market technically closes for a few minutes for the daily banking rollover. Liquidity disappears. Spreads naturally widen. This is normal. However, how much they widen tells you everything about the quality of the broker. On a standard pair like pound sterling to Australian dollar, the spread might be 2 pips during the day. At rollover, it might widen to 10 pips. That is acceptable. But some brokers, often those with poor infrastructure, will let that spread blow out to 50 or 60 pips. If you are holding a swing trade with a 40 pip stop loss, you could be stopped out purely because of this spread widening, even if price flatlined. To test this, hold a microscopic position, a nano lot, through the rollover period on a volatile crosspair. Record the spread width at 4:59 p.m., 5 p.m., and 5:05 p.m. Do this for a week. If you see spreads widening to levels that would destroy your standard stop-loss strategy, you have identified a critical constraint. You now know that you either cannot swing trade on this platform, or you must artificially widen your stops every single day at 4:55 p.m. to survive the witching hour. This is data that a demo account, with its often fixed or smooth spreads, will simply never show you. The fourth and final test is the exit drill. This is the most important test of all, yet almost no one does it until it is too late. It is the withdrawal test. A broker that is easy to deposit into but difficult to withdraw from is a trap. You need to verify the friction of the exit door. After you have traded your bridge account for a month, whether you made a profit or a loss, initiate a withdrawal of your remaining funds. Do not withdraw $5, withdraw the whole balance. Pay attention to the process. Is it a simple click? Do they force you to fill out a PDF and email it? Do they call you on the phone to try and convince you to stay? Do they suddenly claim your ID verification is expired and delay the transfer for 2 weeks? Consider the case of Sarah. She turned her $5,000 account into $15,000. She needed the money for a down payment on a house. She requested a withdrawal. The broker's support team went silent. Then they asked for a notarized copy of her utility bill. Then they claimed her bank details didn't match. It took her 3 months of stress and threats to get her own money back. Sarah could have avoided this nightmare if she had tested the withdrawal process with her initial $100 bridge account. If a broker makes you jump through hoops to get $100 back, run away. If they process it in 24 hours with no questions asked, they have passed the final audit. By performing these 4 stress tests: news latency, phantom wicks, rollover spreads, and withdrawal friction, you are doing the job of a risk manager. You are ensuring that the infrastructure supporting your business is sound. You are stripping away the flashy marketing and looking at the raw plumbing of the exchange. Once you have a demo strategy that works, a set of drills that keeps you sharp, a bridge account that has acclimated your psychology, and a broker that has passed a rigorous stress test, you are no longer a retail trader in the derogatory sense. You are a proprietary trader, managing your own capital. You have professionalized every single aspect of the operation. But even with all this preparation, there is one question that remains. A question of endurance. Trading is not a sprint. It is a marathon run through a minefield. How do you put all of this together into a cohesive long-term career plan? How do you go from day 1 to year 1 without burning out or blowing up? You need a roadmap. You need a schedule. You need to know exactly what to do in month 1 versus month 6 versus month 12. We have arrived at the final stage of our masterclass. It is time to construct the 12-month Zero to Pro roadmap. This is your calendar for the next year of your life. It separates the dreamers from the executors. Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. By continuing to watch or listen to this material, you acknowledge that you are solely responsible for your own due diligence and financial decisions. You are now standing at the foot of a mountain. Most people look at the peak, the financial freedom, the laptop lifestyle, the quitting of the 9 to 5, and they try to sprint straight up the cliff face. They fall. They crash. They become part of the 90% statistic we warned you about in the very first minute of this series. You are going to take the switchbacks. You are going to take the long, boring, safe route that guarantees survival, even if it delays gratification. This is the 12-month Zero to Pro roadmap. It is your syllabus for a self-directed master's degree in capital markets. Months 1 through 3 are officially designated as the laboratory phase. During this quarter, you are strictly prohibited from funding a live account. Your only tools are the TradingView replay engine and a high-fidelity demo account from OANDA or IG. Your objective is not to make money. Your objective is to build a data set. You must execute the 100-trade protocol. You need to log 100 valid trades according to your specific strategy rules. If you hit trade number 45 and decide to change your strategy because you saw a new indicator on TikTok, you reset the counter to 0. This is brutal but necessary. You need a statistically significant sample size to determine if you have an edge. If you finish your 100 trades and your profit factor is below 1.2, you do not pass go. You do not move to month 4. You stay in the laboratory, tweak the variables, and start a new block of 100. This is where most aspiring traders quit. They lack the patience to be scientific. They want to be rich by Friday. But if you are still here, you are the outlier. You treat this like a business R&D department. Months 4 through 6 are the bridge phase. Assuming you pass the laboratory phase with a positive expectancy, you now open your live account with the tuition capital, that $100 to $500 we discussed. You are trading nano lots or micro lots. The goal of this quarter is psychological calibration. You will experience the physical symptoms of risk, the sweaty palms, the hesitation, the urge to close early. Your metric for success in this phase changes. We no longer care primarily about the profit factor. We care about the error rate. A trading error is defined as any action taken that violates your written rules. Did you move your stop loss? Error. Did you take a trade because you were bored? Error. Did you risk 2% when you were supposed to risk 1%? Error. You must track your error-free days. If you can go an entire month without a single execution error, regardless of whether you made or lost money, you have conquered the amateur mindset. You are building the discipline required to manage 6 or 7 figures. The money is irrelevant. The habit is everything. Months 7 through 9 constitute the audit and optimization phase. By now, you have 6 months of data, 3 months of simulation, and 3 months of live fire. You have hundreds of trades logged in your digital auditor, TradeZella, TradesViz, or MIFSpook. Now you stop trading for 1 week. You put down the mouse and pick up the microscope. You act as an external consultant hired to fix a struggling hedge fund. You filter your data. You ask the hard questions. What is my win rate on longs versus shorts? You might find you are a terrible seller but a great buyer. Optimization. Stop selling. What is my performance on Tuesdays versus Fridays? You might find you give back all your profits on Fridays. Optimization. Take Fridays off. What is my expectancy when I trade the euro versus the yen? You might discover the yen is too volatile for your personality. Optimization. Remove it from your watch list. This is the data surgery. You are cutting out the tumors that are dragging down your equity curve. A case study of a trader named Eric showed that he was a break-even trader for 2 years. He felt stuck. When he finally audited his data, he realized that 80% of his losses came from trades taken between 11 a.m. and 1 p.m., the lunchtime lull, when volume drops. He simply made a rule to stop trading at 11 a.m. Overnight, he became profitable. He didn't learn a new strategy, he just stopped doing the thing that didn't work. Months 10 through 12 are the scaling phase. This is the graduation. You have a verified edge, you have psychological resilience, and you have an optimized rule set. Now, and only now, do you discuss capital. You have 2 paths. Path A is the compounder. You slowly add to your own account, depositing 10% of your paycheck every month, treating it like a high-yield savings account. You use the power of compounding to grow over decades. Path B is the leveraged accelerator. This involves the prop firm industry. Because you have a verified track record from months 4 to 9, you can approach capital providers or take challenges from reputable firms. You are no longer gambling on these challenges. You are simply executing the same boring system you have practiced for 9 months. You are not trying to pass the challenge in 2 days. You are passing it in 20 days with zero stress because you know your numbers. You are using their capital to generate income while protecting your own savings. This roadmap is not exciting. It does not promise you a Lamborghini next week. It promises you a career. It transforms you from a gambler into a risk manager. The demo accounts we reviewed, OANDA for precision, IG for execution, TradingView for backtesting, are just tools. A hammer does not build a house. The carpenter does. You are the carpenter. The reality of the market is that it is a mechanism for transferring wealth from the impatient to the patient, from the unprepared to the prepared, from the amateur to the professional. You now have the blueprints. You know which demo accounts to trust. You know how to spot the broker manipulation. You know the drills to run. You know the metrics to track. The information gap has been closed. The only gap remaining is the execution gap. Do not binge watch another series. Do not look for the next best thing. The search stops here. The work begins now. Go download the platform. Configure the chart. Set the date. Start the first block of 20 trades. The market is open. This concludes our deep dive masterclass on Forex demo accounts. If you are ready to begin phase 1, I have prepared a checklist of the exact settings for your OANDA and TradingView workspace to match the professional standards we discussed.